time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Pivotree, symbol PVT on the TSX Venture, trades around $2.82, market cap around $75 million. So quick public company history here. It listed post-pandemic in November 2020, quickly traded past the $10 range and topped out in the $13.50 range with a market cap in the $330 million range, kind of in the tech-related bubble at that point. While revenues were growing, the underlying business was nowhere near worth those levels, and it's seen its share price drop from that high of around the $13.50 range to $2.82 today. And its current market cap, like I said, is in the $75 million range. The viewer question asks us, essentially, with the 80% drop in that range in the share price, does Pivotree finally offer good value? Let's start with what Pivotree does. They are an end-to-end provider of e-commerce, supply chain, and master data management services. They have more than 180 large and mid-market retailers, branded manufacturers, wholesalers, and distributors in North America as clients. The company supports its clients on their digital strategies, platform design, build, implementation, and hosting through ongoing support. Now, it has a strong track record of revenue growth. Revenues have jumped from around
$49.8 million
in 2018 when it started as a pub, or when it goes back to that. I can look at the financials there essentially to about $101.7 million in 2022. Operating income continues to be negative. However, in 2022, it had a loss of $8.6 million. So let's look at its Q1 2023 financial highlights. First quarter, total revenue is $25 million. That's an increase of just 2.2%, but it is also a decrease of 3.6% if we look at constant currency. Total bookings were $16.1 million. That's a decrease of around 15.3% year over year. The net loss was $1.4 million. That compared to a net loss of $3.3 million in the same period of the prior year. So an improvement there, but still a net loss. Adjusted EBITDA was about $900,000. That is 3.5% of total revenue compared to about $200,000 or 0.8% of total revenue. So improving in that from that perspective. Notes from management in the quarterly call stated Q1 saw a healthy level of booking activity, although we are seeing the effects of some extended timelines to close deals when compared to prior years' experiences when we were hitting new records. So our conclusion here, Pivotree holds a solid balance sheet, $15.8 million in cash. That's 59 cents per share or 21% of its market cap. The company, however, is not profitable over the last 12 months, nor was it cash flow positive, or has it even posted adjusted profitability over the past 12 months. Pivotree's price to sales is roughly 0.73, which looks interesting. Based on what we believe are optimistic fiscal year 2023 adjusted EBITDA estimates, the company trades right now at roughly 15 times EV to EBITDA. Given the macro environment and the significant slowing in revenue growth to negative 3.6% in the last quarter on a constant currency basis, and the company's inability to produce positive cash flow historically, we're not recommending Pivotree at present. Now, what could change this is the company's evolution to products employing its own proprietary IP in products, which should progressively push recurring revenues and margins meaningfully higher. This evolution is still early on, but with its proprietary IP now in about 20% of its data projects, the potential is there. But at this stage, it is just potential. We'd like to see more significant recurring revenues, cash flow, before we recommended the stock.
Yeah, good job. Good job. I mean, obviously, recurring revenue is something that we like to see. Can you remind me, what was the percentage of recurring revenue again?
Well, it's 20% their own IP. They have other recurring revenue services that they rank at about 50% of the business. Mm-hmm. They're ranking in that area. So it's decent if it increases over time. But again, that adjusted EBITDA margin right now, while they're trying to bring it up, is still quite low. And we haven't had a full year of adjusted profitability or cash flow, and there's been no earnings. So it is certainly, it has a good share structure. There is a good cash balance here. If they can start to, continue to put their own IP in products, bring it more to a recurring level in terms of 75, get it up to 75% from 50. It is a company that could become interesting, bring those margins up, be cash flow positive. And they have some cash there, 15.8 million, to start making some acquisitions. That would be something that could add to growth. But again, we want to see more profitability in this business. Many of these companies, I'm not saying Pivotree was the exact example, but went public at a time when the markets were just overheated for tech, achieved valuations that were just ridiculous at the time. And, I'm not sure if a lot of them had the discipline to cash flow because money was so easy to come by in terms of financings. They didn't have to have the discipline of cash flow to run your business off of that. Many of them have gotten a rude awakening over the past, 1.5 to 2 years. You've seen, we're talking about many companies on the podcast. We get questions. This stock is down 70, 80, 90%. Is it finally value? Well, you're starting to approach a time where it may become interesting in some of these stories, but many of them either have horrible share structures or they have, they just don't have, they still haven't focused on that profitability. If they can bring it around, bring some cash flow online, they might become orphans. That would probably be a time that we see the time to buy some of these stories. Pivotree needs to increase its cash flow, then we'll be more interested.
And if it truly does have a competitive product or service, then it should be able to drive reasonable profit margins to the bottom line. And that's how we would validate the business.
Well, if some of these micro caps that have come down want to actually gain attention, they have to show they can be profitable based on their business and not just growing the top line and never producing a profit. In the end, you'll burn the cash and then you'll go to the market and it'll be a vicious cycle of issuing shares. It doesn't look like Pivotree, is in that cycle. So if they can now carve out some of the costs that are eating away at their profitability while still being able to grow at least in better times, then it's something that could become interesting. It's not there yet. Certainly not the worst of the companies that have had these precipitous drops that we've seen, that most of them are very much warranted, but certainly not the worst of that group, and one we'll monitor.